Good morning, traders. Thank you for joining us. I'm Michael from Game Edge, coming to you on Friday, October 17th with our pre-market prep session. As always, thanks for joining us. We'll cover our three pillars here as we always do at Game Edge: sentiment, structure, and trend. And then we'll go over some individual equities at the end from the community. You can go ahead and post those post those tickers towards the end when we get to that point, and then I will go over those. As always, join us at gameedge.us, 14-day free trial. All the tools turned on. We'd be happy to have you in the Discord community. All right, let's go ahead and jump right into it. We're looking at our market trend model. This really is the our rudder or our roadmap for how we navigate the overall market. This is based on the tick index, buying versus selling. Again, how market participants are participating in the overall market. Quick orientation: the bolded white line is our cumulative tick, or what we refer to as our CT. This is our tick US. This includes all exchanges, so it can be slightly more sensitive and a little noisy, but we like to look at it. So as the bolded CT is under what we term our railroad tracks or shorter term moving averages, that's indicating obviously more selling as this continues to move down in the overall market. We use this as a trend and momentum indicator. Obviously, if we're moving from lower left to upper right and above all the moving averages and railroad tracks, then there's more buying versus selling. We want to be along the overall market. And if we're sideways to down, obviously more selling, and we want to be a little bit more cautionary and manage our risk appropriately, and then in position to the downside if that's something that you are interested in trading. Also note that our colored ribbon, this is our longer look back period. This is how we position our longer term money in the overall market. And if the red is below the cyan, this is what we call a ribbon flip, and this is a bearish state. And then obviously if the bolded CT is under the colored ribbon, again, just enhances the bearish state there. Orientation up here, this is breadth indicator, new highs versus new lows. As always, we'd like to see the new highs outpacing new lows, indicating more stocks are being bought than sold. This is our filtered cumulative tick indicator, plus 1,000, minus 1,000. This is larger block orders, institutions or larger market participants. As you can see, scrolling back here a few days, and then previously yesterday, we had a significant amount of filtered cumulative tick selling to the downside. If we're below zero, and you see this negative 115,000, so indicating institutions obviously are continuing to sell as we move down with the SPX or price action. And then just our cumulative tick indicator below zero, again indicating more selling. So as you can see, obviously the takeaway is more selling versus buying in the overall market, and this is the trend. So obviously we want to be on the right side of the trend. So that would have been positioning, at least reducing our risk, capital exposed to the overall market on the long side, as well as deltas, and then positioning for short-term move to the downside if that is in your trading type of strategy. All right, our tick RC, this is how we trigger our mechanical portfolios, P-Trans to Peak-X portfolio, as well as our wheel strategy. Again, extensive education in our blogs, as well as our Game Edge Fast Pass, which we'll go over at the end, all free education. And then as always, we cover those trades in our Discord community. So as this bolded CT starts moving into the colored ribbon and below the colored ribbon, we turn the trigger off for our mechanical portfolios. So we will not be entering long trades today. Now, if this does recover back to the upside, then that would trigger back entering long positions. Again, as I discussed previous few days, we're at an inflection point when we had that first move to the downside. And I believe we're at another in one of those inflection points where we're cutting into the colored ribbon here. We're trying to hold above it. But if the bulls do not step up, most likely we'll emerge to the lower portion of this colored ribbon, and that could induce some more overall weakness and selling in the market. If we do recover this to the upside, then obviously that would indicate that more buying is occurring in the overall market than selling. So we'll continue to watch this day over day. So, all right, moving on to the SPXA. Sorry about that. All right, moving on to the SPXA. This is our larger tankers that control the overall market, or what we call our cruise ships. Yeah. So anyway, institutional positioning via the SPXA. Obviously, monthly expiry here. So we're looking at the November expiry coming up. Again, virtually, as we said, no size here. So not a lot of positioning already in the November SPX A. So we'll continue to watch this. As you can see over here, it is call dominated though. So again, that structure would be supportive for pullbacks or moves to the upside. But we want to see this net GEX continue to fill in, indicating where the institutions are positioning for the November expiry. And dogs will be dogs. That is true. Mine likes to bark at anything that moves sometimes, though. So anyway, call dominated. Again, as we talked about, no exposure yet in the November expiry. So we'll continue to watch this as the structure develops after this monthly OPEX. Looking at the SPXA, all expiries, obviously this is filled in. It is call dominated, but you'll notice the significant change from our previous weeks of where this was completely call dominated above and below spot price. Now we're seeing that erosion of the structure continue, at least on the on all expiries, but we are still call dominated. So the call speculation is still maintaining overall control. But as you'll see on the SPX PM expiries, this full net delta, or the net delta column, is full red, indicating that puts are in control above and below spot price. So we'll just keep an eye on this, basically just watching to see how the structure changes after this expiry. Heading into November, and then obviously into the end of the year, into December. Do institutions still maintain this call dominated overall structure and positioning, indicating that it will be supportive and most likely have a chance of price appreciation? Or do we really start to see this change to put dominated and green or red net delta dominated, indicating we could have a larger pullback within the overall market? So we'll just keep an eye on this. Obviously a 40,000 foot view. And then we zoom in with the SPXP. We believe we're the only service that separates the SPXA and the SPXP. Obviously, the SPXA, your 40,000 foot view, your tankers and cruise ships controlling the overall direction of the price for longer term expiries. And then our SPXP, as you'll notice, obviously 0DT, shorter term expiry. These are what we call our speedboats. And these really control the fine movements of price action via intraday or as well as weekly also. Again, put dominated here. You'll notice obviously red net delta all the way up and down the column, above and below spot price. So again, significant change in the overall structure continues to occur. If you zoom back maybe about a week and check out any of our other pre-market prep videos, you would notice this net delta was completely green, indicating call dominated was in control below spot price, which was supportive on any pullback. And you notice that on any pullback, that is that buy the dip that everybody talks about into those in the money calls below us. And then we had significant out of the money call speculation. And we started to see that out of the money call speculation start to degrade via a couple tools we'll go over here in just a few minutes. And then obviously it's come to complete fruition that we're in the money put dominated overhead. And as long as this continues not via expiries or mechanically closing, it will be difficult to move up into these areas overhead. Once we start to see this change, obviously this will start to change to green, and you'll see some of the strikes start to change to green. That would indicate the in the money puts are closing or expiring. And then out of the money call speculation is starting to increase and ramp back up. So that would give us the indication that we may have some upside appreciation in the overall complex. All right, moving on to SPXP GEX ratio. Again, we like to call this a put call ratio, but this is what we call our gamma edge ratio. It's based on short dated call gamma versus short dated put gamma. I spoke about this yesterday, that we had a positive slope and we were moving to the upside a little bit on that up day, but we were still cautionary that this could definitely move back to the downside. As we were not seeing via our delta balance tool, which we'll go over here in a few minutes, a significant amount of out of the money calls speculation or out of the money gamma, short dated call gamma coming into the complex. So again, that ratio was not increasing rapidly. And now we're back below that one level. This is indicating put dominated, as we've already discussed. And the short dated put gamma is controlling the overall complex and structure. So again, this is a weakened state, bearish state until we get back above one, and then continue to push to the upside. As the SPX would push to the upside, then we'd have a confluence of the GEX ratio increasing as the out of the money call speculation increases, which would also increase our short dated call gamma versus put gamma. As you'll notice over here, when we were moving to the upside, our GEX ratio was significantly moving to the upside, also in a positive manner, obviously indicating the short dated call gamma was increasing into the overall complex. All right, moving on to the delta balance. Again, We separate the structure here into left-hand plane, right-hand plane, and then the aggregate, which is the blue dotted lines, the delta balance. So our green is the right-hand plane. That would include your out-of-the-money calls, as well as in-the-money puts overhead. And then the red dotted line is your left-hand plane. Those are the in-the-money calls below us, as well as the out-of-the-money put speculation. You'll notice that the right-hand plane, obviously, when we went over in the web app, was completely put dominated. So that would put that right-hand plane below zero and then down towards the negative 0.5 area. The left-hand plane, again, we still have some in-the-money calls below us, just not a significant amount. And you'll notice that's dropped to the 0.5 level and fairly flat. And then the aggregate is obviously under zero, indicating put speculation or put dominated is in control, as the bears are in control there. One key change here out in time is this expiry. Obviously, we've noticed that it's completely below zero heading into next week. Now, with the monthly OPEX, this could change over the weekend, and we'll get updates on Monday. But this is a very weakened state heading into next week with right-hand plane and left-hand plane significantly below zero, as well as the delta balance pegged at 1. So this could be indicating more weakness into next week after this monthly expiry. So again, we'll watch the OI change over the weekend, and we'll update you on Monday. But again, could be anticipating some more weakness into next week. All right, moving on to SPXP net stack command. Obviously, high sensitivity levels for today. In the money calls below us, 58.50, obviously significantly lower than where we're at with the overall spot price. I think the key takeaway here is on the net delta column is we're in the money calls below us, but we're in the money puts above us. This is what we call our locked horns condition, where it will be difficult for spot price to move up or price appreciation, especially with those in the money puts. You'll notice that the in the money puts are almost 1.5, 1.7 to 1 via the calls below us. So again, these will be controlling the overall complex, again, unless we have a significant change in sentiment and structure intraday via some news event or something like that. Charm, obviously, in the money puts overhead. This will be difficult to overcome. 66.50. That's about the top of our drunken sailor range, as well as our transition levels. So again, we may have a push up towards that level, but then be met with significant overall weakness via these in the money puts overhead and charm condition. And then our gamma condition, or our gamma sensitivity levels. Obviously, you can look at those pretty low here in the right-hand plane. A little bit larger in the left-hand plane. And then our Vanna, if we do see volatility drop, you can look at those areas there. All right, moving on to the SPXP 0DT for today. I put this out there on X, obviously in the money puts winning overhead. So you just notice, just from a quick visual standpoint, that would be very difficult to overcome to the upside unless we have a significant amount of change in sentiment and structure. So that would be closing of these in the money puts overhead and a significant amount of out of the money call speculation. When I say significant, it would have to be very large to overcome these in the money puts. So you need both of those to happen. But we'll continue to watch that. We have tools intraday via our vol-m, vol-d, and intraday volumetric commands in our Discord that's available to our members to watch this in a 5-minute slice over slice. And it's all automated also. So you can check that out as we basically look at those call and put centroids and see if they're indicating that we're speculating to the downside, or if we're speculating to the upside, or if we're in an overall consolidation condition. Confluence of the GEX and DEX transition today, that's going to be extremely important. As we always say, transitions are very important. They're very wide today. Yesterday, my key statement was wide and loose. And obviously, we had significant price movement back and forth and significant volatility. So a little bit narrower, slightly narrower today, but still very wide. Obviously, that's just an indication of the volatility in the overall market, as well as uncertainty of market participants positioning via the overall structure. You'll notice in a significantly call-dominated structure, in a more dampened volatile environment, will be a 5 wide on the transition area. So it's very narrow. Your if-then statements for the trading day are unambiguous. If you're above, you look for movement to the upside. If you're below, you look for movement to the downside. But when these transitions are very wide, once you get inside those transitions, especially yesterday with the low exposure, you notice that the price action was driven very quickly back and forth via the intraday volume of market participants. So for us to have a definable edge, we like to have a very narrow transitions. Obviously, that allows us unambiguous trading. with this wider transition, sometimes it can be more difficult. And that was my statement yesterday. If you don't have a definable edge, staying in cash or not trading is very, very acceptable, especially since this is Friday. It's a monthly OPEX. So, definitely could be some outsized moves today. So a quick takeaway for today is let's move on to the TradingView chart. So I've already overlaid our scripts for today. These are available for TradingView and Thinkorswim. This is the full expiry script. I've just overlaid our drunken sailor range as well as our 0DT transition. So you already noticed pre-market, we've tested the bottom of our 0DT transitions twice, pretty close. These are kind of areas, not necessarily absolutes. So we've come up to 63.34, 63.35, 36 areas, the bottom of transition. So to get into these areas is going to be extremely important. We've already rejected there. So again, if we continue to reject, this is an opportunity most likely to short. If we get into transition, it can be noisy. Not expecting us to move above transition today. Obviously, in trans is the full expiry as well as the top of drunken sailor range and the 0DT. If we do happen to get above the transition area, 60 GEX, 66.80s to the upside, 75 is an important level also. So 75 to 80 would be an area that I'd watch for some stalling. Again, not anticipating that unless we see a significant amount of puts closing and out of the money calls coming into the complex, which we have those tools to watch via our volume metrics. And then obviously the market trend model has to turn around significantly to indicate there's more buying versus selling in the overall market. So that's kind of the game plan today. Manage risk if you're on the long side. If you're looking to short and that's in your game plan and wheelhouse, then transition areas, rejection and transition areas are great short opportunities. Then as always, we have 6,600 down here, which is again, extremely important level, round number, just from a psychological level, as well as options positioning. And then that coincidentally is COTMP, which is where our out of the money, it's a proprietary level where out of the money puts go in the money. And historically, that's an area where we see some sort of supportive type action. But we had a low down there, obviously at 65.30-ish. So that will be important if we ran all the way back down there to test it. But for me today, obviously running into transition areas overhead is key. That's indicating that we're not necessarily bullish. And this could be a bearish opportunity for a short unless we see us move through the transitions and above and start out of the money speculation. So with that, that's our game plan for today. Thank you everybody for joining us. I'd be happy to go over individual equities. You can throw them in the chat or discuss anything else. As always, come join us at gammaedge.us. We'd be happy to have you. Click on the newsletter here tab, put in your email, and you'll be taken to an area, and you'll get these newsletters delivered over the weekend for Beyond. It's our Beyond the Bell. Basically, goes over our philosophy, tools, and how we navigate the SPX option structure. And then free courses go here. Game Edge Fast Pass. This is our flagship options course. Sign up for it as well as these other two courses. Again, our methodology, our tools, and how we go about doing everything. Our blog has significant education content. All these videos are all free. Make sure you click on those. And then as always, click the pricing tab. You'll be taken to our Watt portal, and you'll be able to enter our Discord. Again, extensive trading community, all experiences, all backgrounds. And then our Game Edge team obviously is live every day and in there to help you answer questions and navigate the SPX option structure, as well as check out our mechanical portfolios, P-Trans and P-GEX, if you're not an intraday trader. So thank you again, everybody, for joining us. We can go over a couple things. GLD, yeah. GLD's been on a heck of a run. I mean, just amazing, really. And it's been call dominated the whole time within our overall structure. It's been leading a lot of our scans that we have for our members. So again, call dominated above below spot price. As I discussed yesterday with somebody, I think we were above the PGEX and COI level. So that's an area that I was watching. I'm not sure how far GLD moved up yesterday. We can look at the TradingView chart, but this expiry 400 is PGEX. So still an opportunity, to move up a little bit. And then after this expiry, 400 is still that PGEX level. And then 400 kind of maintains that PGEX level. You do see a little bit of the out of the money call speculation above 400, but I'd assume 400 would be an area that I'd watch for some profit taking or stalling. You see COTMC up there also. That's proprietary Game Edge level. where we see out of the money calls become in the money, and historically that's an area where we see some profit taking. So yeah, GLD, heck of a run, just moved to the upside there. So all right, thank you everybody for joining us. What's the most real-time Gamma Edge tool to indicate on heavy directional move days like happened this week? So our web app. So basically, our web app is the main thing that I would look at. Vol M, Vol D intraday. Yeah, I think I don't know if Tom is asking about multiple days. So yeah. So Tom, if you're asking about multiple days, we have an OI. We have OI change commands that we watch day over day. Our web app watching the structure advance or decline. That really is the yeah, he said real time. So vol M, vol D. So our vol M command and our vol D command. Let me grab one of those. I'll grab the GI or GIF from last night. So you should be able to see this here. Yeah, CT and market trend model. Yeah, Tom. Obviously, that's our core and what keeps us on the right side of the market. But here's our vol M command. You should be seeing this right now. So obviously, we wait 30 minutes or an hour to get into the overall trading day. Roughly about 30 minutes to understand where market participants are positioning. But you'll notice this. These are our call and centroid or call and put centroids will get you orientated really quickly. So the green dotted line is the call centroid. This is the volume or mass of where market participants are transacting contracts, options contracts, and this is the put centroid. Obviously, what will happen here, you'll see very rapidly that the put centroid will start to flatten out and then start to decline. This is indicating that out of the money put speculation is really ramping up to the downside. And then towards here around 1 o'clock, you see both of these linear fit lines and the centroids running negative slopes to the downside. That's obviously indicating that there's not out of the money call speculation to the upside, and there's increasing out of the money put speculation. Then we have a couple other tools that we watch also that gives us rate of change and slope change, and that really is important of understanding if the market participants are changing the overall direction or continuing the trajectory of the centroids into the afternoon, right? So you'll see these kind of, right, you'll see them flatten out, then level off, and then they both get negative slopes. So for us, that's a significant indication that most likely the market is weakening and going to be moving to the downside. And we have some other tools that allow us to look at individual strikes and the volume that's transacted at those strikes. So yeah. Thanks. I'm asking about helping Delta neutral traders to know when to bail out when a massive move is about to happen. So predicting, yeah. So predicting is very difficult, right? Yeah. Delta balance is the one. Delta balance is one of the ones I would go to. So Delta balance basically is showing you what is happening with the structure above and below spot price, right? Yeah, exactly what Paul said. Paul's one of our Paul's one of the founders that he's commenting in there. So that's yeah, I agree. Yeah, we can't predict. But basically what I went over in our pre-market prep into the last Friday was there was lots of signs that the market was weakening, mainly our market trend model, right? And then we were seeing a decrease in out of the money call speculation. When you see a decrease in out of the money call speculation and an increase in out of the money put speculation below spot price, right? Market participants are positioning for something. And whether it comes to fruition, nobody knows. But that gives us the indication that, hey, market participants are doing this. This is how they're positioning with their money. So we need to take notice, right? And then when you see the SPXA, which are institutions, start to degrade a little bit, then that really is an indication that the big boys and girls are changing their overall positioning of the money. So what do we want to do? Well, we want to sit up in our chair and take notice. We want to be not reactive, but proactive in managing our risk. And that would be just decreasing long delta. And if you want to increase short delta, fine. But if you don't, then that's fine also. But basically, it's just protecting your overall capital and managing risk. That's the whole part of the game. And that's what we use our tools to do, is to understand the shifting sands under our feet in the overall positioning of the SPX market. We know the tail wags the dog. We've proven this over and over. with our back testing, with our forward testing, with all of our tools that we put out. And we've been doing this for 3 years, and we really have a good grasp on this, what we call, it's a sine wave in the overall market, but you reach a peak of out of the money call speculation, and then you start seeing the put hedging come in, and you start going down the other side of the slope, right? Now, if we don't see that bounce back up of out of the money call speculation come back in, then that kind of deters of, the overall long positioning. And that tells us, hey, okay, we need to probably start reining in some of our risk, and that's all we can do is manage our risk appropriately. And that doesn't mean hair on fire, go to cash instantly. For us, it's a progressive exposure tool. As the tools indicate, on the long side, we increase our exposure like day over day, right? Maybe it's a quarter, maybe it's a half, maybe it's 3/4, and then we get to full exposure, right? As the market, moves to a call dominated market trend model upstate. And then the same thing conversely on the downside, as the structure starts to degrade and we see the out of the money call speculation start to drop, out of the money put speculation increase, we start reducing our exposure. And that doesn't mean go to cash day one. It means, progressive decreasing your exposure and increasing your hedging if you want. A lot of our guys and gals, in the overall community, they hedge, right? And when the tools are starting to indicate that, right? And basically you're just buying insurance, right? And if the insurance goes to zero, fine, right? You didn't need the insurance. But if you have a long portfolio, then you want to protect that portfolio. So you can start building a hedge. And then you get a day like last Friday where the hedge is great. It worked out, right? And you did exactly what you had insurance for that, once in every 6 month car wreck, or, I'm just using an analogy, or a hailstorm that came through so you can get your roof replaced, right? But that's just how we do it. And that's our progressive exposure model. And it's a mosaic for us, all of our tools combined. As I said, it's sentiment, structure, and trend. Our trends are market trend model. Sentiment and structure are all of our other tools: web app, DBH, delta balance, as well as our GEX ratio, and then understanding the shifting of structures. I mean, it really is as simple as the transition areas moving down, right? Indicating that the speculation to the upside is decreasing, speculation to the downside is increasing. If you just watch the transition areas and whether they widened or narrowed and whether they moved up and down the overall structure, I mean, absolutely. I mean, you would do fairly well, just in a simplistic standpoint. So yeah. And as Paul said, we use if-thens, right? If we do this, then we're going to react this way. If we do this, we're going to react this way. And we try to be very mechanical, a black box, zeros and ones. Obviously, we can't be without complete emotion, but we manage our risk, and that's what we do, right? And we only risk a certain percent on each trades. And, these people out here that are risking full portfolio on a short or a long because, whatever, gold's running to here, dollar's going to here, rate cuts here, that's just not sustainable, right? And if you look at their P&L curve, I would assume it'd look like a roller coaster. We want our P&L curve to be very steady, and that's just incrementally increasing. And you're going to have little blips, but you want your valleys to be very small, right? You want your peaks to be higher, and you want your valleys to be very small. That is the sign that you've become a trader that manages risk appropriately. If you have a roller coaster P&L, and I always encourage everybody to document their trades and document their P&L. It will really be eye-opening in how you want to develop as a trader. And that's what we try to do at Game Edge. We want to smooth out that P&L curve with multiple strategies, right? You can be in multiple strategies. You can be in P-Trans to P-Gex. You can be in a wheel strategy. And then if you want a little bit more higher beta, you can do a 0DT strategy, right? With spreads and how we lay out our morning commentary. And that may just be a very small portion of your portfolio. That 0DT strategy may be less than 5% of your total portfolio that you're putting at risk. The P-Trans may be 30%. The wheel strategy may be 30%. And then you may be long exposure in some index funds for the other 30%, right? That's fine. It doesn't matter. And then your 0DT trading, if you want to do that for the dopamine hit or whatever you want to have, then that's 5% of your portfolio. So that's a very small risk. So if you do something stupid on the 0DT trade, it's not hurting your overall portfolio for the future. And that's what we try to build basically. So, yeah. So anyway, I hope that was a good explanation. Sorry, we skipped over a couple individual. I kind of got on a tangent there. So, yeah. Yeah. Thanks, GGH. Oh, sorry about that. Session's opening there. So, yeah. All right. Thanks, everybody. We're going to go ahead and cut it off here. Obviously, the market is opening this morning. I got to jump back in our Discord with our members. Again, come try us out. 14-day free trial. All the tools turned on. Make it a great weekend. Zero DT level transition is going to be extremely important for this morning heading into today. So pause your player and go back and review. All right. Thanks, everybody. Have a great weekend.